Hey everyone. Last week, the Federal Reserve raised the overnight rate by 25 basis points. And the big question today is whether that was the last rate increase of this cycle. Of course, everyone hopes it was the last rate hike, but Chairman Powell was a little cagey at the press conference. In the past, the Fed chair's been pretty good about telegraphing their next move, but this time he kept saying the decision will be data dependent. So, of course, Chairman Powell didn't come out and say there won't be any more rate increases. But unlike the meeting in June, he also didn't telegraph another rate increase. That's a win in my book. Currently, Wall Street is assessing an 80% likelihood that the overnight rate will not change when the Fed meets in September. In addition, they're saying there's a 70% likelihood the Fed will keep rates flat in November and a 61% chance the Fed will keep them flat again at their December meeting. So generally speaking, the odds-on bet for the remainder of this year is that the Fed will keep rates flat. And that would be a very welcome change for commercial real estate investors. Here are 5 reasons the Federal Reserve probably won't have to raise rates again. First, we've seen some pretty significant declines in several inflation measurements. The Consumer Price Index has fallen steadily since it peaked at 9.1% in June last year. And the Producer Price Index has also dropped dramatically, down from 11.7% in March last year to its current level of 0.1%. We've also seen downward pressure on core CPI, and we're beginning to see some downward pressure on core PCE, the Fed's favorite inflation metric. The second reason is something our research team covered in a recently released special report: the resumption of student loan payments this October. It's estimated that the resumption of student loan payments will reroute about $70 billion per year into debt repayment that might otherwise go into consumption. That's roughly a 0.5% reduction in consumer spending. Siphoning off that much spending should be disinflationary. Don't forget, a significant factor that sparked this inflation cycle was the pandemic and the stimulus-driven surge in spending on consumer goods when the supply chains were messed up. Today, the supply chains are in a much better condition, and the resumption of student loan payments should restrain consumption, especially in conjunction with the third reason the Fed likely won't need to raise rates further. It was the focus of my video last week: personal savings. In a nutshell, excess savings is being burned off, and the total amount of cash in savings accounts and money market mutual funds is moving back into alignment with its pre-pandemic trend. That should help moderate spending in the second half of this year, reducing demand-side inflationary pressure. The fourth factor is that economic momentum is tapering. Job creation, while still positive, has slowed significantly. In the second quarter of this year, we averaged about 244,000 jobs per month compared to an average of 330,000 per month in the second quarter of last year. Again, job creation is still strong and still healthy, but it is slowing down. The fifth factor is more esoteric. Basically, the Fed doesn't really know whether the rate increases are already playing out in the economy or if the true impact is yet to come. Because of that, unless they have a specific reason to raise rates, they're more likely to take a wait-and-see approach, at least over the short term. So, as long as we don't have a significant, unanticipated surge of inflation, the Fed should hold off on additional rate increases. Now, to tie this back to the commercial real estate market, if the Federal Reserve holds rates flat through the remainder of this year, as Wall Street expects, the real estate market will benefit in 3 ways. First, it should help stabilize the lending climate. Borrowing rates may come down a little bit, lenders may stop tightening their lending criteria, and more banks may re-enter the lending market. Second, it will help buyers underwrite assets more accurately because financing and interest rates should become less volatile. That in turn should help reduce the buyer-seller expectation gap. The third way stabilized interest rates will help the commercial real estate market is by reducing uncertainty. Basically, a lot of investors hit pause on their activity because there have been too many variables in play. Stabilized interest rates and the reduction of uncertainty that goes with it should bring more investors back into the market, which will in turn facilitate the price discovery process, thereby further reducing uncertainty. So if the Fed holds rates flat for the remainder of this year, it should bolster the commercial real estate investment climate. But as always, there are a lot of variables in play, so investors need to keep their eyes on the horizon.